A very warm welcome by Karvy Private Wealth. Today we have with us eminent speaker Mr. Shantanu Awasthi from Karvy Private Wealth and Mr. Varun Goel from Nippon India AMC, who would give us insights on post-COVID-19 scenario and investment themes for 2021. Mr. Shantanu Awasthi is the head of Karvy Private Wealth's family office, products, and Karvy International Business. He has an experience of 19 years across wealth management and private banking in India and abroad. He holds a master's degree in economics from Jawaharlal Nehru University, Delhi. Mr. Awasthi has an in-depth understanding of capital markets and economic affairs, both domestic and international. Prior to Karvy Private Wealth, he has served leadership roles at Morgan Stanley, HSBC Dubai, and Kota Group. Mr. Varun Goel is currently an equity fund manager at Nippon India AMC. He is a mechanical engineer from IIT Delhi and an MBA in finance and marketing from IIM Lucknow. With 10 years of experience in fund management focused on Indian equities, he has a track record of delivering impressive risk adjusted returns to the investors by identifying themes and stocks that have provided returns. He has worked with some of the most respected asset and wealth management companies in India. To begin with, I would like to welcome Mr. Shantanu Awasthi.
Thank you, Mehak. Thank you, everyone. Uh, it's been a pleasure to host all of you all. Very good evening and a welcome to today's webinar. Uh, it's always pleasure to host along with the old friend, which is Varun Goel. He's a leading fund manager, and I've known him in the past as a colleague also. He has got a stellar track record in terms of outperformance and overall performance in equities. And I have known him through for almost a decade now. And I think he's not only a great fund manager, but also a wonderful human being. But having said that, today's topic, which we are going to be talking about, is about post-COVID-19 scenario and the investment themes for 2021. Now, when we talk about, there is a general dilemma in the markets, and most of the people are thinking about, should we invest now or should we not invest now? Are the markets high? I mean, particularly when we're talking about the markets are almost moving at a 19.8x P ratio, which is almost 5% premium to the long-term average. When we look at, and that was the forward multiple, but in case if we were talking about the trailing multiple, one would say it is at 24x, and that kind of a multiple is almost 21% times premium. So what exactly and where are we? I mean, how are we going to be investing? Is the new normal going to change everything? We've already witnessed that a lot of businesses have been affected by what happened in the due to the pandemic. We've seen a lot of degrowth in real economy. We've seen certain sectors really suffer a lot. But where does it all take us? On the one side, we have the economy moving in one direction. On the other side, we also have markets actually moving in a very, very different direction. There is a lot of liquidity, and we've seen the markets being touching all-time high, not only in India, all over the globe. Now, when we actually talk about it, what we have witnessed in India is just a V-shaped kind of a recovery. And when we say V-shaped recovery, we've seen that the markets have come up. But compared to the way the world markets have bounced back, Indian markets still are subdued at this point in time. If we were to talk about the world market cap growth, has been almost 12.9%, whereas India's market cap growth has been mostly flat in the post-COVID scenario, if we were to compare with the pre-COVID scenario. India, if we talk about, has averaged around 2.5% of the world GDP. Currently, we are hovering around 2.3% of the world GDP. Is where world market, not GDP, world market cap. So, if we were talking about the Indian markets, the market cap is around 5% on an average. Currently, we're at 2.3. So, basically, there is a scope of growth in the Indian markets. Now, how does one actually go about investing in this scenario? Of course, to give us more in-depth analysis, we will have Varun who will talk about equities. But I just wanted to touch base on a couple of important points which are relevant to any investor. Uh, you know, when we talk about when to invest and when not to invest, the most important point is that we miss out by staying out of the markets. So one thing is that have to be invested at all points in time. cash at bank is basically loss in any way. So basically, if you are looking at it, it has to be an asset location, which is an answer to the entire piece. Of course, there are times when you have to actually be overweight on equities. There are times when you would probably be slightly underweight. But depending on what your goals are, what your objectives are, where you are looking at, what you're looking at achieving, the prime goal for most of the people look at is inflation plus whatever expenses, if they are able to generate that post tax on their monies, is what they look at from a capital preservation perspective. So in order to achieve that, it is extremely important that we are at all points in time diversified across asset classes, depending on whatever your asset location choices are. It will depend on your own risk profile. However, a generalistic view is basically that there is something called strategic asset allocation, which basically means that how much money, given your own particular objectives, should be invested into equities, how much should be invested into gold, how much should be invested into debt, how much should be invested into international markets, your dollar exposure. So there is a combination which we actually look at. Of course, in India, we are slightly lopsided towards real estate. But having said that, that is something, physical real estate is something primary or secondary investment is world over as a choice. But having said that, financial assets allocation is extremely important to revisit the thing in a holistic scenario, rather than comparing that one stock did well or one sector did well. It is actually important to look at the overall portfolio as to how you make your allocations. Now, there are certain interesting facts currently which I would like to highlight over here about the markets. And the facts which I want to kind of talk about is the super cycle theory, which has been now coming into discussion. So if you see, the markets actually move in phases of super cycle, super growth, where we actually kind of achieve a very high growth in the real GDP. Currently, when we talk about, there is a note which had come out, and we are actually almost 77% of what the overall GDP activity is. Now, for this to go into 100%, will just need markets to double from here. This would ideally mean a lot of opportunity in real economy and good companies. There is a lot of liquidity. The central governments as well as the Fed, both, we have seen a lot of fiscal action, and we've also seen the monetary action. A lot of money supply which is there. The balance sheets of Fed has almost kind of doubled or tripled. The fiscal deficit has for US has actually moved from 4 to almost 9%. Now, all these money and these measures have been taken to actually revive the economy and pump in the kind of activity which is required, along with the money which is being made available, so that the economic activity bounces back. What we expect is that around about 2021, when after the pandemic thing is off and the markets actually come back, the real economy actually come back to normal, we actually expect a huge amount of growth in the following years on account of this kind of fiscal measures as well as the monetary measures which are playing out. And we hope that the super cycle of what we witnessed between 2003 to 2008 is going to come in again. This is exactly the way it was earlier. So that is where we are. So to know more about which sectors to look at, how to look at, and what would be the actual scenario in equities, my friend Varun would be in a better position to actually comment on that, what should be looked at. I'm a strong believer that return on equity, certain strong companies with quality and governance will actually tend to keep delivering. With the capital being available, markets are surely about to bounce back. But having said that, of course, how to go about and which sectors to look at, which stocks to look at, and how to manage your monies is something Varun would be able to give us good insight on investment themes which will work in the current conditions. So, Varun, with that, I'd like to invite you and share your pearls of wisdom.
Thank you for a very generous introduction. Thank you for inviting me for this session, and I hope I can add value to your clients. And without further ado, let me start by talking about the topic that we have on hand. So I think we have a very interesting equity market here. This is a phenomenal year in the sense that we started the year with 12,000 on Nifty. We went all the way down to 7,500. in the middle of March. I remember there were a lot of horror stories being written about, in various Western newspapers as to how millions of people will die in India because of COVID, and there will be dead bodies on the street, and all that stuff. So while we have faced a big problem because of COVID, but thankfully things are nowhere as bad as was being previously predicted. So thanks to the gradual opening up of the economy, and also the fact that the disease did not do as much harm as was previously feared, we are now back to 12,000. So 12,000 in January to 7,500 in, let's say, middle of March, and then now we are back to 12,000. This has all happened in a span of 9 to 10 months, so which is a phenomenal year as far as equity markets are concerned. Really a topsy-turvy, right? Where news flows and events have really driven the markets to a very large extent. So we'll try and understand what really has happened. Of course, Indian economy has suffered. We have suffered loss of life. We have suffered loss of people, and businesses have clearly been impacted. But things seem to be getting a little better. So we're happy to share some of the key data points. So Naveen, can we start rolling on the presentation? If we can go to the first slide, please. I think it'll be good to share with everybody what has been a interesting pattern. So in India, if you see, in the middle of September, we had around 1 lakh active cases. And from there, if you look at yesterday, the number of daily cases has reduced from around 98,000 to around 50,000 yesterday. So if you see 20th September 92, then 21 was 86, then let's say 27 was 88. So within a month's time, we have moved down from 98,000 daily new cases being added, to almost 50,000 cases now. And the number of active cases, the number of people totally infected minus the number of people cured, has fallen from around 10.5 lakhs to 7 lakhs as of yesterday, which clearly shows that while the virus is still around, its bite is definitely coming down. Number of people getting treated is increasing every day, because of which the number of active cases out of the 75 lakh odd cases that we have, the total number of active cases is only 7 lakhs odd, so which is less than 10% of the total people infected, which is obviously a positive sign in the sense that economy is getting opened up in a much more fruitful and meaningful manner. Naveen, can we go to the next slide? Yeah, so of course, what the government has done, which has happened all across the world, is that interest rates have been coming down. There has been a lot of monetary stimulus and fiscal stimulus. So let's talk about monetary stimulus. So if you see at India, interest rates are at the lowest level in at least 2 decades, right? So if you see repo rate, we have fallen to around 4%. 10-year GSEC yield as of today is around 5.85. The bottom of the 10-year GSEC yield that we saw in post 2000 was 5.9 in 2009, and this time we seem to have gone even below that. So while the repo rate was much higher in 2009, but this time the 10-year GSEC, thanks to significant amount of liquidity creation by the central bank, is almost at a 2-decade low. Can we go to the next slide, Naveen? And the good thing is that it's not just the 10-year bond yield, which is at a historic low. Even the rate at which money is available for various corporates, that has actually come off quite a bit. So today, the blue chip companies like HDFC, Reliance can raise money at less than 3.5%. Of course, these are short duration money. But even the mid-cap companies, so for instance, Chola Investment, is able to raise 3-month money at 3.5. JM Financials, which has a high risk profile, is able to raise 88-day money at 7%. ICICI Securities is able to raise money at 3.6, which shows that there is a significant amount of reduction in short tenure borrowing rates for the overall economy, and which will definitely get passed on even to the retail borrow. Can we go to the next slide, Naveen? Yeah, so monetary indicators, currency in circulation is up, money supply is up, credit growth, of course, is muted because there has been a lot of risk aversion in the sense that people are still worried. Banks are still worried whether they should actively lend or not, but there is a lot of liquidity sloshing around. Forex reserves is at a lifetime high at around 545 billion as of last month, and we've added almost $100 billion of forex reserves, which gives economy a lot of stability in these tough times. Can we go to the next slide, please? Yeah, another very important thing, I think, from a macroeconomic perspective is that rural incomes or the farm incomes have been holding on quite well. This is the second consecutive year of good monsoons, very rare. Last 10 years, we have seen very disturbed pattern of rainfall. So this year we have around 107, 108% of normal rainfall, because of which we expect farm incomes to be up around 8 to 10%. Even last year, we have seen a 10% growth in farm incomes. So FY19, there was a 1% growth or a flattish growth. And FY20 had a good double-digit growth in farm incomes, thanks to the increase in MSPs and a bountiful crop. And this year, again, we've seen a fantastic Kharif crop. And we believe that because reservoir levels are pretty good, we will see a pretty good winter crop or the Rabi crop, which should definitely boost rural incomes. Can we go to the next slide? Yeah. From a economy recovery perspective, as we know, a large part of the economy has been opened up. So there are some key data points that we are tracking. So if you see GST collections in the month of September were around 95,000 odd crores, which was a growth of around 4% over the September of last year. E-way bills, which is also an indication of the kind of GST collections that we can have, were around 103% in second half of September. Our sense is starting now, the GST collections will start seeing a single-digit growth YOY in October, and this number can actually go up, considering the fact that we had a relatively muted fourth quarter last year, which was January to March 2020 was a muted growth quarter. And if the growth continues to pick up, if the economic activity continues to pick up, we should see a fairly good recovery in GST collections also. Can we go to the next slide? Yeah, bank deposits. I think this is a very, very critical slide. And if you see in the 5 months of FY20, the total incremental deposits of banking system were only 2.1 trillion. This time, in the first 5 months, it was 6.1 trillion. What does it mean? That we had around 4 trillion of incremental deposits. And why do these deposits happen? Because people were just not spending. What people were doing is, because there was uncertainty and fear because of COVID, a lot of people were losing jobs. So people who were having regular incomes also, which is the salaried class or some businesses which were still doing okay, they were hoarding a lot of money and they were putting their money in bank deposits. So this incremental 4 lakh crores, which is 4 trillion, if people start spending this, if people believe that now the COVID fear is coming down, we can afford to purchase the white goods that we wanted to, we can try and spend a little bit on luxury items and go beyond food and staples, there will be a big rush of demand. The only thing is people have to feel confident enough to spend this money. And we are in the middle of festive season. We've just seen last 5-6 days have been a phenomenal e-commerce sales. As you know, both Amazon and Flipkart were having festive sales. We are told that the total sales has been much, much higher than last year's levels, although the final numbers are not out yet. But it seems there is a good start. And if trends continue in this direction, we believe that we should see a good increase in consumer spending going forward. Rural wages, we already spoke about, looking at 10-11% kind of a growth, and which should do well for the overall economy. The next slide, please. This is a very important slide in the sense that there is also a big wealth effect at play, especially in Tier 2, Tier 3 India or the rural India. Why? Because gold prices have been going up. So if you see last year in rupee terms, gold prices went up by 27%. And this year, so far, till September end, gold prices are up 36%. In rupee terms. So together between last year and this year, gold prices up around 60 to 65%. Now, what does that mean? Is that there is a significant increase in the wealth effect, especially in Tier 2, Tier 3 India. As you know, almost every family in India has some amount of gold. And a lot of people use this as a bridge finance facility. So let's say you are a small shopkeeper who's fallen on tough times because of COVID. You can use your loan, your gold, to take a short-term loan of 3 to 6 months. Similarly, if you are, let's say a small business, SME, MSME, or if you are a salaried customer who lost his job and you need money for 3 to 6 months, this is something that can be used to create some short-term liquidity. And that's why we see gold finance companies really doing well, because a lot of people are using this big spike in gold to take short-term financing. So overall, what we are really saying is that while the COVID-related shutdown created a lot of stress, we seem to be coming to an end of a lot of problems. As we speak today, 95% of the economy is functional. A lot of macroeconomic indicators that I can share with you. Electricity consumption is at around 112% of last year's level. Auto sales numbers in the month of September around, four-wheeler sales were around 29% higher than last year's level. Two-wheeler sales were plus minus 10% of last year's levels. So we are seeing a continuous uptick in macroeconomic indicators. And hopefully, if we have a good festive season and there is no second wave. So in India, clearly, the data point shows that the first wave seems to be ebbing. And if there is no big second wave, it doesn't force people to do a second round of shutdowns, we should see better times ahead. So that's the overall macroeconomic perspective. From an overall market point of view, of course, markets have bounced back very, very strongly on the back of improving data points. From a EPS perspective, markets earnings perspective, last year, Nifty EPS was around 480 rupees. This year, we believe it's very difficult to call because we still don't know how the lockdowns will play out, but we are looking at plus minus 10% of last year's level. And more importantly, if we see the last year's, the next year's FY22's numbers, we are looking at around 600 to 650 rupees EPS on Nifty. And based on that, we are looking at around 19 times 1 year forward earnings for the broader market, which is definitely not cheap, but not very expensive. The last 10-year average is around 17 times. And of course, let's keep in mind that we have seen 4 or 5 years of very subdued earnings growth for broader markets. There have been several disruptions like demonetization, GST, and now because of COVID. So there is a possibility that we see if there is no further shock, we could see a decent recovery in the economy going forward. So does it mean we will not see a correction? I'm not saying that. We can always see a 8 to 10% correction in the broader markets. But do we expect markets to go back to 7,500? My answer to that is no. And unless there is a very scary second wave where we are forced to shut down the whole country, which looks like a low probability event, we don't see markets going back to the levels that we saw in the month of March. I think a big learning, as far as we are concerned, is that it's a good idea to be present and stay invested in the market while we can decide on the allocation. I know a lot of investors who are very scared of COVID and who kind of pulled out money when the market started recovering in April and May. But look, from a 9,000 on Nifty, we have come to 12,000. And therefore, having a knee-jerk reaction to these kind of macro events is probably not a great idea. So building on that theme, we believe it's a good idea to build a long-term equity portfolio in the next 9 to 12 months. If we start putting money to work, let's say invest 30% now and invest the remaining 70% over the next 9 to 12 months, one can create a very good foundation for equity market returns in the next 3 to 5 years. Keeping that in mind, we have a product which we call the Nippon India Equity Opportunities AIF Scheme 5, or what we call the $5 trillion opportunity, which is AIF, a category 3 AIF, alternate investment fund, which we launched sometime in January this year. Theme of the fund is very simple. We are investing in those sectors and companies which we believe will trigger the next round of growth as far as Indian economy is concerned. So just to give you a perspective, India in 2004 was a $0.7 trillion or a $700 billion economy. As we speak today, India is a $3 trillion economy. And maybe this year we will see a downtick, but we expect next year things to get better. So from 3 trillion to a 5 trillion, we require 9 to 10% of nominal GDP growth, which means if we have 5 to 6% GDP growth in real terms and we have 4 to 5% inflation, we can do that 9 to 10% GDP growth, which is needed in nominal terms to get to that $5 trillion economy mark in the next 6 to 7 years. And that's something we believe is definitely doable. This year, of course, we will see a negative GDP growth of around 10%. But next year onwards, FY22 onwards, we believe growth can definitely come back. So what are those sectors and themes which will do well? If you see the graphic which is there in front of you on the right-hand side, there are certain themes like water and sanitation, health and wellness. So this is part of our overall theme of ease of living. We are invested in paint companies, FMCG companies, some hospital chains we believe will do well because India has learned after this illness to invest in healthcare, and a lot of people are now going to be dependent on medical insurance to get themselves and their family treated during times of illness. And we believe that corporate hospital chains will also do well. And this bucket, the ease of living bucket, constitutes around 20-25% of this portfolio. The next bucket really is what we call self-reliance in technology and research, which is really the key theme. If you see what has this lockdown taught us, it has taught all of us to shop online, get our food delivered online, get groceries delivered online, avail some of the services online. So digital economy or e-commerce will become very, very big in the next 5 to 10 years. We're already seeing a lot of traction in some names. So we have invested 10 to 12% of the portfolio in digital themes. We invested in one of the largest ad tech or the advertising technology company in India, which is backed by Microsoft. We believe that can grow at 30% plus for the next 3 to 5 years and can do really well. Then we invested in one of the largest e-commerce platform in India, which owns one of the largest food delivery companies in India and also owns a large website for recruitment and real estate. Then another sector that we believe should become fairly large for India is specialty chemicals. I think after IT, which has been a big success story for India in the last 10 years, in the last 20 years, we believe specialty chemicals is the next big segment. So while India has missed the bus on semiconductors and electric vehicles, we lost out to countries like China and Korea and Taiwan. On textiles, again, we have lost the bus. We missed out the bus to countries like Vietnam and Bangladesh. But chemicals, especially the specialty chemical base, I think there's a very large opportunity. India already has a $35 billion chemical industry. This can become a $100 billion industry in the next 7 to 8 years, according to various estimates. We believe there will be several companies which will emerge out of this, several multi-bagger opportunities. And this again, another 10 to 12% of the portfolio is present in this theme. So altogether, around 25% of the portfolio is present in these sunrise sectors, which we believe will create a lot of wealth in the next few years. The third bucket, what we call the banking and digital infrastructure, we have some corporate lending names which are really beaten down because of this crisis, which we believe can do really well going forward. We have companies in the life insurance and the general insurance space, and also we have telecom names, sector which is coming out of 5 years of consolidation after a brutal price war. We believe telecom sector can do really well from this point onwards, considering that only 2 to 3 players are left, and there is a significant increase in pricing power, which we believe should start getting reflected going forward. And finally, we also invested in some utilities and civic amenities. There are companies in the bearing space that we believe should do well because of the dedicated freight corridor, which is getting operational next year. Then there are companies in the gas distribution space, considering that India is trying to move to CNG and cleaner gas rather than the coal-based energy. That is again something which can do a lot of growth. And then of course, we have companies which are benefiting from all the metros that are being constructed in various state capitals. So altogether, we have around 25 odd names in the portfolio. This portfolio has been in existence since 1st January. So this is the full portfolio. You can see it's a good mix of large, mid, and small. So we have around 50% of the portfolio in the large cap space, around 40 to 50% in the small and the mid cap space. A lot of bottom up ideation that we have done, a lot of new ideas that you would have not seen in various other portfolios. In terms of returns, Naveen, can we go to the next slide, please? Can we go to the, So thankfully, if you see, despite a very, very tough environment, the portfolio has kind of held on. The thing which we are most happy about, that not only the portfolio has outperformed by 15-16% since the beginning of the year, but the portfolio actually fell a lot less when the COVID related downtick started in February and March. And when the uptick has started post-COVID, the portfolio has actually gained well also. So both sides of the market, the portfolio has actually outperformed, as a result of which the portfolio has delivered a return of 11.9% positive return compared to around minus 5.4% in the benchmark Nifty 500 since the inception of the portfolio. Of course, there are only 9-10 months of existence of this portfolio, but we believe that we have the right stocks which can see 15 to 20% earnings growth in the next 3 to 5 years, and which should lead to significant compounding as far as these companies are concerned. Also very important point is the result update. If you see the Q1 results, Q2 results season has just started. we will see one more month of results coming in. But if you see the first quarter, where most of the companies were shut down because of COVID, Nifty companies delivered a minus 15% profit growth. But our portfolio companies, thanks to their very resilient earnings model, delivered a 16.5% earnings growth. So there was a 30% plus outperformance in terms of earnings by our portfolio companies. Also, if you see on last year basis, while Nifty companies delivered a 0% earnings growth, our portfolio companies delivered almost a 90% earnings growth. So I think this, in our view, is a fairly good, stable, sturdy portfolio of large cap and middle small cap companies, well diversified across various sectors, should benefit from various. And we also have a very interesting option available in terms of staggering out the investments. As I said, that we are not saying that there can be no correction in equity markets in the short term, but if you build a good equity market portfolio for the next 9 to 12 months, you can start by putting 25% of the money now, and then rest can be spread out over the next 1 year. Naveen, would you like to take people through this plan? Naveen?
Yeah, yeah. Thanks, Varun. So my name is Naveen. I'm from Nippon, India, the AIF team. So we're giving this investors a unique option in this, where you can park 25% of your capital initially, which will be invested into equities, and the balance can be given through an SIP mode, which will be directly debited from the bank account on the 8th of every month. So if you're giving a commitment of 1 crore, 25 lakh rupees can be given initially, and the balance 75 lakhs can be given over a period of 15 months, 10 months, or 5 months, right? So in case investors want to park at least 50% of their contribution immediately, you have an option to do so, and the balance can be given up over a period of 5 months or 10 months, right? So I don't need to get into the benefits of averaging. So I think everybody has the experience of SIPs. So we've started this first of its kind in the AIF industry also. Thank you.
So I think with this, we will end our presentation, and it's back to you, Shantanu.
Hi, thanks Varun, thanks Shantanu. It was a wonderful, I think a very short script, crisp presentation covering the entire economy asset allocation. So questions are obviously flowing in. So I have few questions lined up, Varun, to start with. You already mentioned, let me first congratulate you on the excellent performance beating the benchmark indices also in
Thank
your
you so much.
portfolio.
Thank you.
It's excellent. So very keen to know, like what exactly is the criteria for stock selection, because you mentioned clearly that it is a bottom-up approach. So what are the exact stock selection, the criteria that you follow, if you can throw some light?
Yeah, sure. So see what we have, I think Naveen has just put the slides. We have what we call the must 5 investment framework, where every company that we buy has to follow these 5 parameters. So we are very, very clear that we want to buy companies only which are extremely high on corporate governance. If you see last 5 years, there have been a lot of accidents in terms of poor quality banks and NBFCs going bust. There have also been examples of companies getting into trouble because of shareholder pledge, promoter pledge, and all. So we are very clear. We don't want to be investing in companies with high shareholder pledge with any corporate governance concerns. Second, we don't want to invest in companies which have too much debt. So I'm very happy to share that most of the portfolio companies have either negligible debt or zero debt. And this is especially useful in times like COVID, when a lot of companies did not have any revenue or income for at least 3 to 6 months. And those times, companies which had a lot of debt had find it difficult to service those interests and all. Second, we are looking at companies which have ROCs, ROEs more than 15%. So capital allocation is extremely important. Then we are looking at companies which have been paying consistent dividend. Most of them have been paying consistent dividend because because they have been generating surplus cash and they are happy to share it with the minority shareholders. Then, of course, the most important thing is whether there can be growth. We believe most of the portfolio companies can deliver 15 to 20% on a compounded basis in terms of top line and bottom line. So these are some of the parameters that we are looking. I'm very happy to share, not just in this portfolio, but all the 5 AIFs and the 4 PMSs that we manage. We have ensured that there is no accident in terms of corporate governance. That and as as the Peter Lynch says, it's very hard to go bankrupt when you don't have any debt, right? So we like to follow it and try to minimize the number of companies having debt in the portfolio.
Great. Naveen, a second question to follow up. You mentioned clearly that for last 2 years, normal rainfall, we are expecting a bounty on the Kharif crop side also. So one sector that is, you have got one stock only, which I was looking at, Balkrishna. So any view on the auto sector? Will there be a bounce back? Because COVID has seen it is in a turmoil.
Yeah, so we have around 8 to 10% allocation in this space. We also have a two-wheeler company in the portfolio, which we believe should see significant uptick in growth going forward. So see, I think auto sector is a lead indicator of the economy. If you see, even before the broader economy slowed down, the auto sector actually started slowing down in 2008 August. That's the time when Supreme Court also came up with some guidelines on overloading and insurance and all that stuff. And since last 2 years, auto sector has actually been struggling. So what we are seeing is the first signs of growth coming back in the auto space. Now it's still early days, but our sense is there is a very robust recovery in the rural sector. Rural, especially the two-wheelers and the four-wheeler side, is seeing very robust growth. And our sense is this is gradually going to broaden and will get into the urban areas also as the COVID-related lockdowns really reduce. So auto, in our view, is beginning to do well, and we believe auto is actually always the leader whenever the cycle turns, and it looks like it will also be the case this time.
Correct. Thank you. Shantanu, next question for you. It's a question that is there. So obviously, I know economics is your passion, and you also spoke about asset allocation. So how do you place the international investment in your asset allocation? And also a second question to it. I've seen I've been actually a witness to your asset allocation strategies, specifically the tactical portion. So what do you feel should be the tactical asset allocation right now?
So, to answer the question, when we talk about international markets is of course a substantial chunk. When I actually spoke about almost 2.5%, India has always averaged around 2.5% of the overall market cap. And when you talk about it, there is an opportunity. There's a large cap opportunity. There's a developed market opportunity. There's an emerging market opportunity. It's a different kind of opportunity. Having said that, what happens is traditionally India has always witnessed a very high growth rate, and hopefully will continue to witness a very high growth rate. Now, from an overall diversification perspective, definitely when we talk about India, and especially in India, your capital account convertibility is not there. It is restricted in terms of you can only wire $250,000 abroad. So given that restriction and over and above that, also a strong home country bias. In any country, there is a home country bias. So there is almost 90 to 95% of the investments are basically typically based in the country where you are actually based out of. So domestic country home bias. But having said that, initial diversification of 5 to 10%, and of course there's a limit to it in terms of $250,000 per year, is definitely, it deserves allocation outside. It deserves allocation into a well diversified portfolio, into developed markets as well as other emerging opportunities. Having said that, when we talk about the balanced portfolio, it would be more skewed towards our domestic markets itself. And therein, of course, depends, it's the thumb rule. What people typically take is depending on, there are many factors. There are demographic factors, there are your personal risk profile factors. But if I were to actually construct, there are, and say some moderate profile guy with a middle age would probably look at 50% of his portfolios into equities, and balance when it is divided between debt, around about 8% into alternate assets, which would include private anything, and around about 2% to be held into liquid or cash assets at any given point in time for emergencies. And beyond that, some exposure into gold. Of course, gold has been going up. It's not something which is basically recommended to have very high exposure. It's because long-term returns of gold are mostly low. So from that aspect, that is what we recommend as a strategic asset allocation. Sometimes we go overweight on equities, and overweight on equities, when we say the highest returns in equities come out when the markets tend to remain overvalued. So that while you are a value investor, you might say that markets are hovering around below average and probably hovering in the range of, say, 16 17 PE or 15 PE, then there could be longer periods, prolonged periods, where we have not seen returns. It's like for the past decade or so, the returns have been very subdued on equities. And as I was speaking about super cycles, I strongly believe, on the account of the fiscal flow which is coming in and the monetary support which is available worldwide, definitely there is going to be a bounce back. And as the bounce back comes in, there is definitely going to be a super cycle of another 3 to 5 years, where we might see a huge spurt of growth. And this scenario is very similar. There are data points to prove that the scenario is very similar to what was happening around about 2002-3, before the actual run from 3 to 8 happened. So we would see such kind of a super cycle coming in, is what our opinion is over here. And we definitely are tactically overweight on equities by 5% to 10%.
Great. Also on the debt side, Shantanu, just to pick up from that thing, you have been also quite I will illustrate it with a simple example. Like your debt side call has been also pretty accurate, and where you have picked up very carefully chosen credit debt funds, and you have always mentioned that underlying is very important, and you have also sometimes not agreed with the credit rating that has been given. You speak on the underlying and getting into the balance sheet. If you can throw some light, because that is where people have their money stuck, or sometimes they find it difficult, because that is also very interesting.
So actually, debt somehow has become a very bad word. Especially and that bothers me sometimes, because Varun was also talking about companies he wants to look at, and the whole market is talking about companies which are basically not borrowing. But essentially, debt markets are important and integral part of the economy, and not everything is going to get financed by equity itself. And essentially what happens is, as the economy moves back, and there are these are very difficult scenarios which we've seen, and that's where you see credit defaults happening and other things happening, and that's where we've seen even large corporates actually struggling. But this having said that, this problem was not, of course, because of COVID. It was, we had our set of problems which have been there for the past almost a decade now, and where we've seen the NPAs grow and grow. But however, what we've seen in the past is, with the IBC coming in and some resolution happening, we've seen a fresh bout of capital being pumped into public sector undertaking banks, and also some resolutions coming in have given a ray of hope. And as we strive through this crisis, and as the demand picks up, there definitely be opportunities in the debt piece. Debt piece, of course, it's extremely important, that you are very cautious and you have a proper understanding of how you're going about it. There is definitely a credit play available. We've seen the credit spreads between the lower rated bonds actually being higher. But having said that, quality is of utmost importance, and it is important to actually look into what companies you are getting into. Many times the ratings might be very dubious. It's very difficult to understand, and it's important to actually really delve into the portfolio and look at opportunities, and also understand all the nuances of debt instruments, because there are many multiple debt instruments which people do not understand, and it is extremely important to understand those nuances and that and get into debt. For a simple investor, I would recommend that you could probably look at a short term, or you could look at a short term, or something which is in the liquid overnight space. Don't get into duration play at this point in time, because interest rate seems to be bottoming out. And beyond that, the second piece which could be there is, if you're looking at, you could play a credit play, maybe a double rated bonds which have a very higher spread than what average has been. So there could be some opportunity around those places.
Thank you, Shantanu. Varun, a very specific question for you. It is on the view on the public sector undertaking. This is from one of the investors who has got also exposure on the CPAC ETFs.
I think largely what we are seeing is two problems. One is the supply overhang. There has been a continuous supply from the government side in terms of disinvestments through various vehicles, either directly or through ETF platforms. So I think that overhang stays. Second is the governance thing, right? So people tend to believe that private sector has better corporate governance as compared to PSU sector, especially in terms of protecting the interests of the minority shareholders. So to that extent, I think public sector bank does get public sector companies, I would say, not just banks, tend to trade at a discount to the private sector. So I think also there is a lot of times that public sector has a social interest. So there is nothing wrong in it because that's how the government wants these entities to work. But some of those actions might not be in the best interest from a purely shareholder return perspective. So I think one has to look at company by company in terms of individual companies, balance sheets, strength of business, competitive advantage, and stuff like that. So we do have some exposure to public sector, but largely the companies, as you can see even in this portfolio, are the private sector ones. Because largely we believe those are the better governed companies. But we do have a few names where either the public sector company is in a quasi-monopoly kind of a position or the governance is better than other companies. And so we are not averse as such. We don't have any rule that don't buy PSUs, but look at them selectively where there is a merit to pick them up from a bottom-up perspective.
Thanks, Varun. So one more question. We have been seeing that last 2 years, though the mid and small caps were underperformer, they are starting to catch up, right? So yeah, and if you look into the PE or Nifty PEs, it is, as Shantanu also mentioned, it is quite elevated and at a premium to the averages, right? So do you think that there is a mid cap rally that is pending? And or how are the fund managers handling this situation with almost some stocks around 30-40% down?
See, if you look at the mid-cap space, so we saw mid-cap peak. If you see, let's say, a broad-based mid-cap index, let's say around Nifty mid-cap 100, it peaked at around 22,000 in January 2018. And then it fell almost 50% from the peak. And we had the bottom sometime in March this year at around 11,000. So exactly 50% correction from the top to the bottom. And the 2-3 big reasons, one of course was the economy went to a slowdown, but also importantly from a technical perspective, we had the SEBI change in regulation in 2018 where they said, look, large cap funds cannot be holding more than a certain percentage of mid caps and small caps. So there was this whole SEBI reclassification exercise which happened in 2018, which also triggered some kind of mid and small cap selling. Now what we are seeing, of course, there are early signs of reversal. Not just in the economy's prospects, but also in regulatory actions. So if you see last month, SEBI came up with a new round of regulations where they said that now, large cap funds, multi-cap funds will need to have a minimum holding in these sectors, right? So for instance, multi-cap funds now supposed to have 25% in large, 25% in mid, 25% in small, right? So that itself is a very big change purely from a fund flow perspective. And if that is implemented, we are not saying every fund in the industry will do that because some might want change in classification because it might be difficult to move them. But if even 30-40% of that change actually happens, there is a lot of flows which can come to the small and mid cap space. So that is one from the fund flow point of view. Secondly, we are seeing some of the mid cap companies also doing quite well. So in fact, if you see the performance of some of the mid cap names, especially during COVID times, they have proved that the models are quite resilient. So I think more than the size, I think it is about whether you are in a leadership position in your own sector. So a lot of sectors which are small, and therefore the leadership companies are also mid caps. But as long as you are number one, number two, number three in your own sector, we have seen companies do well. And therefore our sense is, leadership companies, good clean managements, good clean balance sheets, even if they are mid caps, can do well even in turbulent times. And therefore there is a reason and a logic to look at them now with regulatory changes also becoming more favorable. There could be a more broad-based participation in mid caps.
Great. Varun, extension of another question, like auto has been quite a bit of underperformer. Another sector that has been out of favor is the real estate and the infra. Your view on that? Do you think there is a real estate bounce back that is going to come soon?
So honestly, we are not yet clear on this. We are also trying to figure this out. I can share some data points. So if you see the daily registration, so just to give you some examples, let's say in a state like Maharashtra, which is a very large state, includes big cities like Bombay and Pune, the daily registration for residential real estate, which is apartments and houses, is running at around 4,500 daily. Now this is more than the pre-COVID number of around 3,500, which is a very, very healthy. Not only we have recovered fully, we have actually gone ahead of the pre-COVID level. This is also because in states like Maharashtra, we have a big stamp duty cut, because of which transaction charges have reduced materially. The pan-India data is of course a little different, but we are seeing some early signs of recovery. Now, we don't know, what we are not really sure whether this is just pent-up demand which will be there for a few months, or this can sustain. I think also one very important thing which has happened in real estate, there is a big consolidation. Thanks to RERA and GST, we are seeing that organized sector builders are becoming a lot better, and they're becoming much more powerful in terms of access to financing, in terms of corporate governance and all. So clearly there is a shift from unorganized to organized in real estate space, which is going to be very material. So even if the sector is, let's say, beginning to recover, the organized real estate companies are gaining market share, and therefore as such they are doing well. That's point number one. Second, let's keep in mind that interest rates are at a 2-decade low. So you are able to take a home loan at 6.9, right? This is unheard of. At least in last 15 years, I have not seen home loan rates at 6.9 or 7%, right? So even if you believe 6.9 is a teaser rate, but if you actually go out, you will find that you are able to get a loan at 7.1, which is still very low. And so interest rates are at a decadal low. We are seeing no price movement in real estate in last 7-8 years. So there is a time correction, if not price correction, which has happened. A lot of schemes going on from banks and builders at this point of time. So definitely there is some uptick. Now, whether this can sustain or not, time will tell. But prima facie, I think things look optimistic, at least at this point of time.
Correct. Thank you, Varun, for that. I think one more sector. I think I will take the view of Shantanu this time. Shantanu, what about the banking sector? Another laggard.
So, definitely in economy like India, we, as spoken by Varun, and I completely kind of is, agree with that there's no dominant sector per se. We don't, like, we do have IT, we do have oil and gas, we do have automobiles, we have everybody has pharma industry, everybody has certain pie. We don't have a dominant sector like the entire economy is dependent on IT, or the entire economy is dependent on something or the other. And especially with a company, with a country which is actually a developing economy, credit and money is actually extremely pivotal. It plays a very important role in terms of how the financial inclusion happens, how the money flows to various people and various sectors. So in my opinion, banking per se, so of course BFSI is a much bigger term. It includes insurance, it includes broking, it includes finance companies, all the other components which could not be direct finance companies also. But having said that, there also we see a lot of scope of penetration, a lot of growth scope. Banking per se, with definitely any sector doing well will need funds, and as they need funds, the credit offtake will happen. And wherever the credit offtake happens, the beneficiary of that is going to be the banking sector. Banking sector works like a overall multiplier. So it's because of the leverage balance sheets which banks hold. On one side, they really fall down a lot also when the economy is not doing well, which we witnessed recently. But the opportunity lies in the medium to long term. The opportunity lies. We've seen substantial correction. Of course, it is going through its own set of problems. What's going to happen of the moratorium? What is going to happen on the NPAs? What are the real NPAs? There's some clarity coming in, but then there of course RBI is also bothered about it, and there are a lot of actions happening around. But in terms of quality banks and quality companies, I still strongly feel there is an opportunity in the medium to long term, because as the economy comes back into action, and as we move back to pre-COVID levels, and beyond that, as we continue to grow beyond that, each of these sectors, there will be a demand for money, and simple beneficiary of that is going to be the banking sector. So that how and when it plays out is extremely difficult, because you can't predict it to the day or to the T. But yes, surely there's a huge opportunity there for the banking sector.
Thank you, Shantanu. So, Varun, there are a lot of questions flowing up, like on currencies, like on forex reserves, fiscal deficits. For Shantanu, I think specifically, what should be the percentage of debt? I think we have answered mostly all of those questions in a lucid manner. The other question, I've got a very interesting question. So, this is for both the speakers. So, what is the COVID scenario has the pandemic, I will say, has definitely. Yeah, Varun, could you hear me?
Yes, I can hear you.
Yeah. So this question is for both the speakers. So I think one by one we can address the question. You can address the question. So in this current scenario, what are the three headwinds that you are looking forward to, and what is robbing Shantanu and Varun's sleep?
See, I think if I can give it a shot, see, there are a lot of concerns, so there will always be, right, in life and in markets. It's not like everything is going to be hunky-dory, and there are obviously going to be challenges. So I think the first and the most important challenge is that we are just still dealing with a very major global pandemic, and we have not yet fully come out of it. While the number of people impacted has reduced, but we're still having new patients on a daily basis, right? So one, of course, how this whole illness is tackled, how soon we can have a vaccine, how can we control it as early as possible, and then provide relief to a very large segment of population which has been impacted by this. So that will remain a challenge. Second, I think from a broader economy perspective, we have seen a slowdown even before COVID, right? So we were seeing slowdown in growth, and as such, economy requires some amount of stimulus. So how to achieve a balance between fiscal deficit and growth, and how to stimulate the economy, that is something which needs to be addressed. And then, of course, there are global events and headwinds. We heard geopolitical, geostrategic issues in terms of India-China tension. We have a US presidential election which is coming up. Again, something to be bothered about or worried about. Of course, these are things which are beyond control, and as such, we can't really do much about it. But that's something to keep at the back of our head. And so these are some of the important things that I would watch out for and see how it plays out.
Thanks, Varun. Shantanu, you're on mute. Can't hear.
Headwinds, there are multiple challenges. Of course, as we speak, when we're talking about the opportunities, there are opportunities which will be there. In terms of we have this whole thing of China migration into India or Vietnam or Bangladesh. So one side is that we have the other emerging nations which have been actually acting very fast and have been lapping up the pie. We've kind of moved slow over there, and in certain places we've not been able to kind of really move very fast. So that is one of the headwinds in terms of the from a growth perspective as we look at the overall macro opportunity. But having said that, at the micro level there are multiple challenges which we can face. So one of the challenges is of course the competition from neighboring countries which are also emerging markets, which have done very well in the past and which will continue to give us competition. Second piece which is there is that we have to kind of come out with more reforms in the future. If we do not, and if we drag our feet, it could be a lost opportunity for us as a country, because the world, the money and everything will not wait for long for you to kind of, they will give you time. They know that there is a consumption demand within India, but that superlative growth which we want, the growth will continue, but the superlative growth which we want might not happen if we do not actually look into and we do not work with the reforms which are required to actually move forward. A lot of people do talk about the increasing fiscal deficit might be a concern at this point in time, but current scenario, I do not think that is a concern. Reason being, it is extremely important to first live through the phase, and whether it is, and world over, there's a strong consensus actually coming amongst the economists that a fiscal stimulus is required world over. The traditional way of looking at that, whether your uh, forex reserve will sustain or not, uh, we are in a comfortable space there, and I think the rating agencies, as well as more than rating agencies, the capital flow which has been actually happening is kind of ignoring it, because everybody's looking at an effective demand coming through with that. So that will not be a concern. But yes, surely how we implement the reforms going forward, and how we kind of face the challenge from other competitive countries which will try and eat into the share. So these two will be the headwinds which we might face.
Thanks, Shantanu. I think a lot of questions are there. I think I will answer them personally to all the investors. I commit to answer them back, also write to them back, going in 2 to 3 days time. And with that, I think you can share your idea, Shantanu, or some closing remarks for the event.
I think it's been an interesting session. The best part about Varun sessions are basically that is full of information and full of key data, which actually helps us a long way in terms of understanding how to position. Secondly, the thing is, data is backed with a lot of research and a lot of inputs which can be implemented on your portfolios. Uh, See, the idea with Varun is that he's always gives you themes and ideas which you can implement in your portfolios. We can always speak generic and an overall thing, but the way Varun has presented and actually given the themes which can be looked at, the 5 trillion opportunity which he is talking about, we already as getting into a 3 trillion space. So all the opportunities, how we actually get something out of it, that is what is going to be important. One final word from my side to all investors is, while the markets are doing great, the cost of actually sitting on cash is going to be very, very high in the longer term, because what you look at is the compound annual growth rate, or what is the overall growth rate which you generate on the portfolio on a longer period of time, and cash becomes a drag. In case if you are slightly scared about the markets, I would say, or you are sitting on lump sum and you want to kind of invest, it is the best way to invest is to stagger your monies. And as we stagger, I mean, one of the best ways would be give it to the fund manager, like maybe Varun or any one of them, where the option is that they tranche out the money within the next year and a half, and what better than a fund manager taking a call on the money. So that's what will be my closing remarks. And I would like to thank all the participants. I'd like to thank all the panelists, and I'd like to thank Nippon for making Varun available, and Varun for taking out his time. I would like to also thank all our clients who've been through the session and actually heard us. We'll be more than happy to actually take forward any queries, questions. You can always contact your relationship manager. We will be more than happy to do one-on-one sessions with you. Thanks a lot.
Thank you, Shantanu. Thanks a lot to the Karvy team for inviting us today for this session. My best wishes to everybody in this festive season. Thank you so much for having me.
Thank you. Thank you, Varun. Thanks.
Okay, Shantanu. First of all,